Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know first, Volkswagen's 45% China profit collapse forces a tech partnership with rival Xpeng, risking its future. We'll explore how this power shift could transform Western automakers into low-margin hardware assemblers, a trend dubbed the Foxconn-ification of the industry. Second, Apple blocks AI coding apps from its App Store, sparking fears it's protecting its 75% margin services business over innovation. So we'll discuss why this move is seen as security theatre and what it means for developers facing new EU regulations that challenge Apple's control. Third, Microsoft's stock suffers its worst drop since 2008 as Wall Street fears its AI strategy could turn it into a dumb pipe. We'll analyse why its low 3% Copilot adoption rate is a turning point and how its rivalry with former partner OpenAI could affect competitive dynamics. Fourth, OpenAI's record $110 billion funding round and $840 billion valuation clashes with its move to cut costs and shutter products ahead of a potential IPO. This discussion will reveal how this pre-IPO discipline connects to the immense cost of building AGI and what it means for the future of tech. Fifth, a US vocational gold rush creates six-figure salaries for mechanics, proving human judgment can outdiagnose AI in high-stakes jobs. Today, we'll take a closer look at this trend and its implications for a future where cyborg professionals blend hands-on expertise with digital tools. Let's start with a single statistic that might just change your entire perspective on this company. A titan of the auto industry just saw its profits in the world's biggest market get cut nearly in half. Volkswagen's operating profit plummeted more than 50% from approximately 19 billion euros to 8.87 billion euros. The reason why is a massive warning sign for every Western automaker. And this isn't just about market share, it's a symptom of a much deeper internal crisis. For years, Volkswagen has been trying to build its own advanced software, pouring billions into an in-house division called Cariad. But according to reports, that division has been plagued by massive delays and financial losses, posting an operating loss of over $2.5 billion in 1 year alone. This internal failure is actually the key to understanding why a giant like VW is now forced to turn to its rivals for help. For decades, Volkswagen was a dominant force in China. Now it's turning to a Chinese rival, EV maker Xpeng, for its core hardware and software. This is a complete reversal of power. Chinese companies are proving they can build the software-defined vehicles customers want faster and cheaper than anyone else. So what's a software-defined vehicle? Essentially, it's a car where the most important features from the driving experience to the entertainment system are controlled by software, much like your smartphone. The value is no longer just in the engine and the metal, but in the code. This is a fundamental shift that many legacy automakers are struggling with. Chinese drivers want to do their banking or order takeout using voice commands from their car. They can't do that in a Chinese-built Volkswagen, so they're going elsewhere. This move to partner with Xpeng highlights the stunning speed of this shift. Together, the two companies brought a new vehicle to production in just 24 months. They built its core digital architecture in 18 months. And analysts called that timeline unheard of in the West, where a new car can take up to 5 years. So how is this China speed even possible? Research from firms like McKinsey points to a few key factors. First, Chinese EV makers use agile development, working on everything at once, while Western companies often use a slower, step-by-step process. Second, their supply chains are deeply integrated, meaning parts suppliers and car makers work in lockstep. And finally, the regulatory environment is more streamlined, cutting down on bureaucratic delays. While Volkswagen has a similar tech deal with Rivian in North America, experts point out the Chinese partner may already have the edge. One analyst put it bluntly, Xpeng is already there and Rivian wants to get there. This creates a huge strategic headache because Volkswagen is now effectively running two completely different regionally locked technology systems. Think about that. One brain for its cars in China and a totally different one for North America. This creates massive challenges. It can drive up R&D costs, complicate the supply chain, and make it incredibly difficult to create a consistent brand experience for customers around the world. This all leads to a critical question. What is the long-term risk for a legacy giant like Volkswagen? The danger is that they become a simple contract manufacturer, building the metal shell while the high-value software and technology that define the modern car are made in China. This is a scenario some experts are calling the Foxconn-ification of the auto industry. The name comes from Foxconn, the company famous for assembling iPhones for Apple. The fear is that automakers could end up like the hardware makers of the PC and smartphone eras, building the low-margin physical product, while a tech partner controls the high-margin brain and the entire user experience. And believe it or not, Foxconn itself is now getting into the EV business, aiming to build cars for other brands. At the same time, VW's investment gives Xpeng a huge boost in credibility, even as Xpeng is openly planning its own aggressive global expansion. VW could be funding and training its own future global competitor. As one industry expert stated, the power dynamic has completely flipped. The shoe is on the other foot. And I think more and more people are starting to realize this is real. Their products are significant and they are a threat to our livelihoods. We were just talking about how software is reshaping the auto industry, and that brings us to the company that practically invented the modern software ecosystem, Apple. The company founded on putting power in the hands of the people is now being accused of taking it back. At the center of it all is Apple's App Store, the toll booth for a services business that raked in an unbelievable $109 billion last year, with gross margins over 75%. A while back, we talked about Apple's stunning pivot to become the Switzerland of AI, even reportedly letting you swap Siri's brain for third-party assistants like Google's Gemini or Anthropic's Claude in an upcoming iOS update. Keep that in mind, because today's development pulls in the opposite direction. And that 75% margin, it's astronomical. It means for every dollar Apple makes from services like the App Store, 75 cents is pure profit. This is the engine that powers Apple's growth, and the company will protect it at all costs. The threat? A new technology called vibe coding, which lets anyone build a working app just by describing what they want. Continuing our last discussion about Apple opening the door to outside AI at the OS level, the situation this time is different. It's not about assistants answering questions. It's about apps that generate and run code. And Apple has blocked at least 2 of these apps, including Replit, from updating in its App Store, citing safety concerns. Now, you might be wondering, what exactly are these safety concerns? Now, get this. Apple is pointing to its App Store Review Guideline 2.5.2. This rule says that an app can't download or run new executable code after it's been approved. The idea is to prevent a safe app from suddenly turning malicious, but you have to wonder if this is about genuine security or just a form of security theater. Let's be real. The iOS ecosystem isn't a perfect fortress. We've seen major vulnerabilities like the Darksword exploit that reportedly hit over 220 million iPhones. This suggests that while security is a valid concern, it might also be a convenient excuse to protect that 15 to 30% commission Apple takes from every sale. And as we noted a while back, Apple's neutral gateway strategy works best when it controls how AI operates on the device. Advice is fine, unvetted code execution is not. But this is where the story gets complicated. Apple says it's just enforcing old rules. The key distinction Apple is making is all about how the code is handled. Replit's app works by generating and then running code inside what's called an embedded web view, which Apple sees as a violation. In contrast, another AI tool like Anthropic's Claude, which is allowed on the store, operates as a conversational assistant. It gives you code advice, but it doesn't actually execute the code on your device. So technically, Apple is following its own rules, but it's a very fine line that just happens to cut out a potential competitor. We previously analyzed Apple's willingness to let assistants like Gemini or Claude plug into the OS itself, and the latest development is that Apple seems comfortable with AI that stays in a conversational lane while drawing a hard boundary at anything that could route around App Store policy by running new code. Yet, just weeks after blocking Replit, it added AI tools from competitors to its own development software, Xcode. And Replit says it's been in the App Store since 2022, with Apple approving its app over 100 times with the same features it's now blocking. This dovetails with what we discussed about Apple's deeper partnership moves. Reports suggested Apple could leverage Google's powerful AI to train smaller Omni-device models. Folding those smarts into Xcode perfectly fits that Omni-device first narrative, while third-party code execution inside an app does not. In a direct statement, Replit said, "We are surprised and disappointed that Apple would block us from releasing updates. The move has already knocked the company from the number 1 position in developer tools on the App Store down to number 4. What this hints at is a possible internal conflict at Apple. You might have the App Store team, which wants more apps to drive revenue, clashing with the developer tools team, which wants to protect the dominance of its own software, Xcode. This kind of internal tug of war could be a reason for Apple's seemingly contradictory and delayed AI strategy. Or, as we framed it before, it may not be a contradiction at all. The Switzerland of AI posture at the OS level can coexist with a clampdown on any path that weakens Apple's role as the primary gateway. This all begs the question, what's the real endgame? According to one Vanderbilt antitrust professor, monopolists want to control the direction of innovation away from things that would disrupt their monopoly. That maps neatly to Apple's recent moves. Invite big AI models through the front door where Apple sets the defaults, but lock the side doors that let third-party apps execute new code and potentially bypass the toll booth. The irony is that these new AI tools helped fuel a 60% surge in App Store submissions last year, the highest in a decade. Now, by blocking them, Apple risks chasing those same builders to the open web where no one needs its permission to ship. But that's not the whole picture. The real turning point could be the open web, which is getting stronger. For years, Apple forced every browser on the iPhone to use its own WebKit engine, which limited what web apps could do. But now, because of huge regulatory pressure like the Digital Markets Act in Europe, Apple is being forced to allow other browser engines. This could trigger a renaissance for the open web, making web apps just as powerful as native iPhone apps. It creates a real viable escape route for developers who are tired of Apple's rules. If Apple truly wants to be the neutral platform for every major AI, as we discussed before, it may soon have to prove it in the browser too, not just in carefully controlled OS integrations. The company that almost failed in the 90s by locking down its hardware is now facing a new generation of innovators, and it's making a dangerously similar move. The difference this time is that Apple says it's building a neutral AI gateway at the operating system level while tightening its grip on anything that threatens the App Store's cash machine. Speaking of tech giants navigating the tricky landscape of AI, Microsoft just hit a major bump in the road, closing out its worst quarter on Wall Street since the 2008 financial crisis. The stock plunged a staggering 23% in the first quarter, a steeper drop than any of its tech peers. The reason? Wall Street is getting cold feet about Microsoft's massive bet on artificial intelligence. The fear on Wall Street isn't just about the spending, it's about what Microsoft might become. They're worried about something called the dumb pipe paradox. The concern is that Microsoft is spending billions to build the AI infrastructure, the digital pipes, but that other more agile companies will build the valuable apps on top, leaving Microsoft as a low-margin utility provider. It's a story we've seen before in the telecom industry, and investors are spooked. A while back, we analysed how OpenAI's push to avoid vendor lock-in by courting Amazon was a first crack in that very pipe. If the apps can live on someone else's turf, Microsoft risks ending up as the plumbing rather than the platform. While the company still dominates with Windows and Office, its centerpiece AI assistant, Copilot, is failing to gain traction. A bombshell number reveals that just 3% of commercial Office customers have actually signed up for it, as users flock to rivals like Google and OpenAI. To put that number in perspective, the latest research shows the adoption rate is actually around 3.3%, but that's out of 450 million potential Microsoft 365 users. The low adoption rate suggests that Microsoft's strategy of just bolting on AI to its old software isn't working as planned. One analyst put it bluntly, writing that Redmond is in a pickle. This situation also points to a bigger shift. It's happening amidst a wider tech downturn. Some are calling the SaaS apocalypse, with one industry founder declaring that much of traditional SaaS is dying. Companies are now looking at AI native startups that are rebuilding workflows from the ground up, which could pose a fundamental threat to Microsoft's entire Office empire. And the drama isn't just on the outside. Inside Microsoft, a major executive shakeup saw the head of Copilot development move to a new role, a change one former trader called a demotion at best. However, if you zoom out, you'll see another layer of strategy at play. This wasn't just a simple demotion, it was a major strategic pivot. That executive, the high-profile AI star Mustafa Suleyman, was reportedly moved to lead a new division focused on superintelligence. Microsoft is trying to build its own advanced AI models in-house to reduce its strategic dependence on partners like OpenAI. A few days ago, we talked about the Microsoft OpenAI alliance fraying. This in-house push is also about leverage if that relationship keeps sliding toward rivalry. Then there's the biggest plot twist of all, OpenAI. Microsoft's key partner, the company it famously invested in to get a head start in AI, is no longer an exclusive ally. The two are now becoming direct competitors, with OpenAI launching its own services for enterprise clients. We previously analysed the looming legal showdown over OpenAI's AWS exclusive Frontier platform and Microsoft's claim that Azure has exclusivity for OpenAI's core models. Remember, Frontier sits at the application layer, which OpenAI and Amazon argue skirts that core model exclusivity, a clever and risky distinction. That's exactly why both sides have been scrambling to avoid a courtroom blow-up. And this isn't just a future threat, it's happening right now. We're talking about a situation where OpenAI has launched its own enterprise platform that competes directly with Microsoft's own offerings. It's gotten so intense that reports are surfacing of Microsoft and OpenAI sales teams literally running into each other in meetings while pitching the same corporate clients. This is a dramatic shift from partners to rivals. And as we noted a while back, there's a regulatory twist here too. If Microsoft pushes too hard to enforce exclusivity, it could hand antitrust regulators the very evidence they're looking for. And yet, despite the stock plunge and the struggling Copilot, Microsoft's cloud division, Azure, is on fire. Revenue jumped 39%. And its backlog of business from companies like OpenAI has more than doubled to an astronomical $625 billion. We previously emphasized how hosting OpenAI's core models on Azure was the linchpin of that growth. The AWS carve-out at the application layer doesn't break the letter of that story, but it complicates the spirit of it, and it sharpens investor worries about where the real margin power will accrue. Now, here's where it gets interesting. That massive Azure growth creates its own hidden problem, the Azure cannibalization dilemma. Microsoft has a limited supply of the super powerful, super expensive GPUs needed for AI. CFO Amy Hood has even said they are prioritizing these scarce resources for their own internal products, like the underperforming Copilot. This means they are choosing to use that capacity for their own struggling product instead of selling it to high-paying external customers like OpenAI. It's a massive opportunity cost that puts a ceiling on Azure's growth potential. Continuing our last discussion, it's a triple bind. Favor your own apps and you cap infra revenue. Push exclusivity and you risk antitrust blowback. Loosen the reins and you edge closer to becoming the dumb pipe investors fear. This puts Microsoft in a high-stakes balancing act. It's in an intense, multi-front war for AI supremacy against competitors and even former partners, all while trying to justify its colossal spending to an increasingly skeptical Wall Street. We were just talking about Microsoft's rivalry with its former partner, OpenAI, and that brings us to our next story. OpenAI just closed a record-shattering funding round for $110 billion. That number pushes its valuation to a staggering $840 billion. And this isn't just about a big number. This funding reflects the astronomical costs of building cutting-edge AI. We're talking about massive investments in computing power and attracting the absolute best talent in the world. It's a signal that the race for artificial general intelligence, or AGI, requires a war chest unlike anything we've ever seen in tech. A while back, we talked about how OpenAI sprinted to monetize spinning up an ad business that annualized past $100 million in just weeks, yet kept that rollout intentionally slow to protect trust. Today's raise underscores why. Even with new ad dollars, the real costs here are measured in data centers, GPUs, and frontier research. But this is where the situation takes a more complex turn. At the exact same time OpenAI is securing this historic investment, it's also aggressively cutting costs. The company is retreating from hefty spending plans and even shuttering products, including its short-form video app, Sora. Continuing our last discussion about how pulling powerful tools like Sora directly into ChatGPT amplified compute demands and safety risks, this move looks like a direct response to those pressures. Trim the most resource-intensive, highest-risk surfaces while the company gears up for the next phase. So the thing is, this is a classic pre-IPO move. Investors, especially those eyeing a public offering, want to see a clear path to profitability. So OpenAI is streamlining. Take the Sora video app. The research suggests it was incredibly resource intensive, making it unsustainable in the short term. By cutting experimental and expensive consumer products, OpenAI is pivoting hard toward high-margin enterprise customers and API services. It's a strategic retreat to focus on what makes money now, even while raising funds for the distant future. We previously analyzed the split with Anthropic OpenAI testing an ad-supported mass market model while Anthropic stayed premium and ad-free, and flagged how OpenAI kept ads throttled to less than a fifth of eligible US users on a given day. The latest development is that despite ads proving they can work, IPO discipline is pushing OpenAI to prioritize enterprise and APIs over a rapid ad ramp. The company behind ChatGPT now supports more than 900 million weekly active users, and the revenue figure is jaw-dropping. OpenAI is now generating $2 billion in revenue per month. A while back, we were talking about over 800 million weekly users and an ad pilot pacing to $100 million a year. Today's scale jump shows how the core product is carrying growth, even as ads remain deliberately cautious and secondary. The investment round was co-led by giants like SoftBank, with Amazon and Nvidia also committing significant amounts. Microsoft, a longtime partner, participated as well. This presents a fascinating duality. Amazon, Microsoft, and Nvidia aren't just investors. They are OpenAI's biggest partners, customers, and even competitors. This is a dynamic called co-opetition. For example, Amazon committed $50 billion, partly by expanding a deal for OpenAI to use its AWS cloud services. Meanwhile, Nvidia's investment helps ensure OpenAI keeps buying its essential GPU chips. They are all financially entangled, betting on OpenAI's success while also competing for dominance in the AI space. It's a strategic web with enormous risks and rewards for everyone involved. OpenAI itself says this funding gives it the resources to continue to lead at the scale this moment demands. They believe they are building the very infrastructure for intelligence itself. The significance here is that when OpenAI says infrastructure for intelligence, they're talking about more than just data centers. They are aiming to build the foundational layer for the entire global economy, something as essential as the electrical grid or the internet itself. The geopolitical implications here are huge. We are witnessing a private company building and controlling a technology with the strategic importance of a public utility. This raises serious questions about who holds the power in an AI-driven world. And as we noted before, that's why they've been so conservative with ad monetization. If ads were to undermine trust in the answers, the entire infrastructure thesis takes a hit. But there's one more critical fact. Despite bringing in $2 billion a month, the company is still burning cash and is not yet profitable. Even that 9-figure ad run rate we discussed barely dents the burn at this scale. This is the core conflict. OpenAI is in a high-stakes race against its own massive valuation. It has secured the capital to build the future of artificial intelligence, but it's simultaneously shutting down products and reining in spending, all under the immense pressure to prove that an $852 billion company can eventually turn a profit. For now, the consumer ad play stays cautious by design, while the focus shifts as we've been tracking to enterprise revenue and API services that can show clearer, nearer-term margins ahead of a potential IPO. After all that talk about astronomical funding for artificial intelligence, let's ground ourselves in the physical world. A 23-year-old diesel mechanic is already earning well over 6 figures, and he's not alone. While headlines are filled with panic about an AI robocalypse, a quiet revolution is happening in workshops and on construction sites across the country. What's actually happening is that the United States is facing a critical labour shortage in these fields, which is driving a new vocational gold rush. This isn't just a random trend. It's a strategic shift, partly inspired by countries like Germany, where their dual vocational system, blending classroom learning with paid apprenticeships, creates a powerhouse workforce. For students, the return on investment is undeniable. A 4-year college degree can cost upwards of $180,000 when you factor in lost earnings, while many trade programs cost a fraction of that and get you into the workforce earning money years sooner. Meet Cale Mouser. 5 years ago, he started working on trucks. Today, he's a national champion in diesel technology, calling his work sleuthing, like Sherlock and Watson. He's part of a new wave of young adults choosing hands-on trades and finding massive success, completely shattering the old stigma against vocational school. The demand is so high that the workforce development group Skills USA has seen its membership swell to over 440,000 students, with employers begging for more competitions to find this talent. And these competitions are on another level. Think of them as the esports of manual labour. The annual Skills USA National Championship is a massive event spanning an area equivalent to 31 football fields. We're talking about more than 6,700 state champions competing in over 100 different events, judged by nearly 2,000 industry experts. This gamification of trades with points and leaderboards taps into the brain's reward system, making these careers more exciting and attracting a new generation of talent. And the competition is fierce. In one of the toughest events, teams have just 16 hours to frame, build and finish a mini home, complete with working electrical and plumbing. Eva Carroll, a 20-year-old national silver medalist, was the only woman on her division's podium. And while trailblazers like Eva are proving what's possible, it's also true that systemic barriers remain. As of 2024, women make up just over 11% of the construction workforce. And while that's the highest it's been in 2 decades, retention is a huge problem, with some reports showing women leave the industry at 3 times the rate of men. So Eva's victory isn't just a personal win, it's a major statement in a field that desperately needs to attract and keep more diverse talent. After initially getting pushback for choosing a field that would entail hard labour, she now says, "It's cool that I get to beat a bunch of dudes that do this all the time." And interestingly enough, this isn't just about being good with your hands. An MIT economist points out that these jobs require something AI can't easily replicate: human judgment, adaptability, and the ability to make high-stakes decisions in ever-changing environments. When we talk about human judgment, we're actually touching on something called embodied cognition. This is the idea that our physical, hands-on interactions with the world are a core part of how we think and solve problems. When a mechanic like Cale is sleuthing, his brain is integrating years of sensory motor experience, the feel of a certain vibration, the sound of a specific engine knock, the resistance of a wrench. That physical knowledge allows for a type of diagnostic reasoning that is fundamentally different from the abstract data processing of a computer. From forensic science students learning to analyze crime scenes to mechanics diagnosing problems a computer can't even detect, these are the jobs where human expertise is becoming a premium. The ultimate proof comes directly from the workshop floor. Cale Mouser, the 6-figure mechanic, shared a recent experience. "I just diagnosed a transmission the other night where the computer didn't even know anything was wrong." Ultimately, it's not about humans versus machines. It's about collaboration. The future technician will be a kind of cyborg professional, blending their hands-on expertise with advanced digital tools. For example, companies are already deploying augmented reality tablets that give mechanics X-ray vision, overlaying digital wiring diagrams and component information directly onto the physical engine they're working on. AI will flag potential issues, but it will be the human technician who uses their judgment to interpret that data and make the final call. His final verdict is the real bombshell: AI will not replace the skilled trades.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.